Good morning, digital wildcatters, and establishing how incredibly important BDE is. We kind of went away for about a week and a half, 2 weeks. We had an episode that didn't record. We recorded at Empower a little while ago, dropped that last week. The whole fucking banking system has collapsed since we were together last.
Shit, I mean, you know,
we're going to have to do this every Monday now.
We might be the cause of it because you know how world leaders listen to our show. They didn't know what to do, so we give them a break and they fuck everything up.
We let them.
So the playbook wasn't updated weekly that led to the indecision or the wrong decisions.
There we go. All right, so let's jump in. The first domino that fell, Silicon Valley Bank. I mean, crazy, right? Arguably the premier bank of all the venture capitalists, et cetera. Kaboom. What say you, Kirk?
Well, you know, there was a great article by a NYU professor that I follow, Professor Galloway. I read his shit, but sometimes he's really thought provoking.
Scott Galloway.
Yeah, you know Scott.
Yeah.
I tweeted again to him yesterday about this. I'm like, why not let Silicon Valley Bank fail in the first place? But let's put that on the side. I'm a customer of Silicon Valley Bank, and thank God I have access to my deposits. But it's a clusterfuck for a couple reasons. First is they were mismanaging the bank, complete mismanagement. They didn't even have a risk officer for last 9 months. They thought that interest rates were always going to stay around zero, so they didn't hedge correctly.
No. Hold on. They actually hedged against interest rates going lower. I mean, interest rates were effectively zero, and they supposedly had hedges against even lower interest rates. But yeah, go ahead.
No, they let hedges drop off. I mean, I'm just thinking if you sort of look at the under the covers of what happened with Silicon Valley Bank, scary on mismanagement, but I think there's a clearly a much larger story here about the consolidation of banking. The fact that you know our current government immediately stepped in to say, hey, we're going to make everyone whole, which is interesting because they were backpedaling, you know, weeks prior about ever doing that again. So
yeah, really the only thing I have to add here, and as most equity guys, when it comes to analyzing banking issues, mainly ought to keep their mouth shut. But if you look back in kind of historical context, Washington Mutual was the largest of the wave of failures around the great financial crisis, and that was $307 billion. There's a nifty bubble chart that I think I sent around yesterday. It's quite illuminating, at least to someone like me. But the combined Silicon Valley Signature Bank totals about $320 billion just in those two banks. You know, I would have thought maybe smaller than that, but you know, here we are with a bit of an order of magnitude of historical precedent. What that all means for further bank consolidation, I don't know, but
let's do this real quick because there's a shot my mom might actually watch this. So just kind of basic banking 1, 2, 3 is you take deposits and everybody has a savings account or a checking account. So you get that money. The bank then turns around and loans it so people can buy cars, houses, whatever the case may be.
Right.
So deposits, you can get your money out whenever you want, right? i.e. that's a short-term thing. Loans, you get paid back over 3 or 5 years, and that's a long-term thing. So they talk about mismatch duration. So anyway, Mom, that's the fundamental issue. If rates go up, guess what? If you don't pay higher rates on the savings accounts, people pull their money out, but you don't have the money because you loaned it to Kirk to go buy his Lambo or whatever.
That's right.
So that's kind of the fundamental problem. Here's to your point, though. Washington Mutual was the big one, and that was back, when did they go under? 7, 08?
08.
Something like that. Well, they wrote all the rules that we're playing with now. Did you have a smartphone back in 07, 08?
No, I think I still had a BlackBerry.
Yeah, I had a BlackBerry.
It's the coolest
but I couldn't
ever.
I couldn't go on an app and withdraw money.
Not at all.
Silicon Valley Bank had $42 billion withdrawn on Thursday.
Yeah.
And so we were, again, this is rules written for old technology, not updated for the day. And, bank runs happen a lot quicker.
I'll just
these
say,
days.
though, just on a side note, it's not really relevant, but Silicon Valley Bank's digital tools, they're really bad. So I'm surprised what word is on the street, and being an LP in a few funds, I got some real inside information on sort of what startups and funds were doing, because most of the venture capital funds bank with Silicon Valley Bank too. They were advising their customers to pull their investments to pull their money out, and it created. And once one fund does it, everyone talks in Silicon Valley, so it's a nightmare waiting to happen. Actually, what's interesting is I'm surprised that no one was watching Silicon Valley Bank itself, and the risks just sort of grow and grow because they were buying treasuries and kind of how they were trying to offset this risk is real interesting. Now, once a bank run happens, you're screwed because of the bank's business model, and there's nothing we can do about that. But I'm super curious that some of the white knights are saying, well, we're keeping our money in Silicon Valley banks. We want to stabilize the bank. But behind the scenes, everyone was get your money the hell out of there.
Right.
Yeah. And it's the real problem they're trying to contain is the first and second and third derivative issues, like, small companies being able to make payroll, for example.
Yeah.
That
That's a
have
big issue.
nothing to do with, the business of banking per se, or maybe even venture tech, but companies that are trying to make payroll out of deposits or accounts, at a bank at which, you've had this sudden kind of torque of duration mismatch, and the funds aren't available.
I will say, though, which is kind of a funny story, is that when I started my last company, my investors wouldn't allow us to bank with Silicon Valley Bank because of their credit rating. So it's interesting, because of how big my investors were, they were looked at Silicon Valley Bank saying they're not credit worthy, which I found to be a little bit of at the time I was like, what are you talking about? But actually they might have been onto something.
I think I'd heard of Silicon Valley Bank before, but what was the big, you've been in the game for a lot longer than I have, for sure, on the tech entrepreneur and the VC side. What was I guess the emergence of Silicon Valley Bank with that kind of core
and the allure,
right? What was that all about?
Yeah,
I mean, it almost has. I mean, I hate to say this because I wrote extensively on the whole. What was it? What's the name of the workup? What's the company that went under that was $1 billion that were renting to startups? They had Class A real estate. What's that name of the workup? Not workup.
What WeWork?
WeWork. This almost is a WeWork story because it all started, I think, whenever they started the company, was the fact that no one was catering to startups. And why? Because a big bank, why would you cater to a startup? Because startups have no money. They have no credit rating. They're broke. So Silicon Valley Bank started really to help entrepreneurs, and they do things like better than anyone else, like venture debt. I'm about to close a venture round, and Silicon Valley Bank will loan me money as a bridge before I get actually funded. They're great at doing things for entrepreneurs. Now, the challenge is entrepreneurs, as we were saying, can't make payroll because all their money is at Silicon Valley Bank. So, I mean, it's an endless cycle, but it's almost interesting. No one else there was very few other players in the game that would cater to startups. And when you start a company, especially if you're raising money from savvy angels or venture-backed or venture funds, they all bank with Silicon Valley Bank. So it's almost like, do you want to be part of the club or not? And if you're a startup raising money, you want to be part of the club, right?
Well, you know what Silicon Valley Bank did first, and as someone who used to sit in that seat, it was a really cool thing. If you're running a private equity firm, you're always the largest individual LP in the fund, right? Well, Silicon Valley Bank comes in and says, we'll loan you half that.
Right.
We'll loan you 2/3 of it. You put up the first 20% of the money, we'll put up the next 65%, and then you put up the the final, whatever the math is to finish that out, it's 25%. And that's like crack cocaine to a VC, right? You mean I just have a line of credit to make my LP investments instead of tying my own money up for 10 years? So that
I forget that service for the venture funds is priceless.
And guess what? Me as the venture capitalist going to turn around and tell my investments to do. Oh, guess what? You're banking there.
That's right, and that's what they did.
Does it then create some sort of concentration risk just based on the risk appetite of the bank's customers?
It's we always joke about an MLP. When you look at an MLP, there's a pipeline that kicks off cash flow, right? And the MLP has so much debt on it, let's say 4 times EBITDA on it. And then you have the equities of these MLPs that are held by consolidators who then put debt on top of that. And you look up one day and there's like 10 times EBITDA on that pipeline. I think that's what was happening to the risk of these VC companies is you were just stacking debt all throughout the system on this.
Someone would say that when the masses don't see something that's obvious, we like to call it a black swan event because we're just too stupid to look at the data. But the reality on this scenario is that as an entrepreneur, if you go to JP Morgan Chase, for example, and you say, hey, I need a bridge fund, I'm about to close a round, I need money to make payroll, Chase will say, well, let me take it to my credit department. And then they run it up the flagpole. 5 weeks later, they're like, we can't do it because we don't really have the processes. Silicon Valley Bank's like, how much you need? So from a micro level, it made sense why startups go to Silicon Valley Bank. It's a greased pole that everyone knows how to ride on. But what I think we're now get to see is that they were taking a lot of risk. There was a lot of concentration risk, but the risk of the bank itself, they got over their skis and no one corrected it.
So John Jacoby, who for years invested the Stevens family money, he was Jack Stevens' right-hand man. His line,
the Arkansas Stevens?
The Arkansas Stevens. I worked for him for 7 years. Oh. And so one of the...
By the way, congratulations, Taylor Moore, University of Arkansas Razorback, and winning his first PGA Tour event yesterday.
I have a Go Pig Suey hat
over my boy George.
Are we at the 6 degrees of Kevin Bacon moment yet?
Yeah, I think.
Let's get there.
I think we're
that's usually me.
But what John Jacoby used to say, oh, hell, every bank goes broke at some point. We've seen contagion, though, off this. I mean, CS. I mean, Credit Suisse.
I mean, UBS was just loving that moment.
Yeah, so UBS is buying Credit Suisse for $3 billion.
I think it's around 2. I didn't see a final number.
So I had seen 3. It's 2 pennies on the dollar. The Saudis had invested 3.5 weeks ago, so they're losing 90 some odd % of their money.
Damn,
debt holders, certain levels of debt are getting 0 on this deal, and UBS is getting Credit Suisse and some sort of government guarantees.
I think the guarantee amounts to around $6 billion or slightly north of that is the last I heard.
So crazy. I mean, so do we see that?
And they're about to write down $17 billion of the bank's riskiest bonds. So, I mean,
they call them tier 1 bonds, but they're still senior to the equity, and the equity got something and ostensibly senior debt got nothing.
The interesting thing about this run is, the Saudis, by statute or something, were capped at 9.9%. So supposedly the run on the bank starts when the Saudis said, no way, we're not going to invest more. But that's not what they said. They were like, regulatory wise, we can't own more than that. So that started the run. I mean, do we see this? I mean, all the talk is the regional banks in the United States. Do we see the run happening? Let's do this. On a scale of 1 to 10, 1 being Chuck Yates running on a Saturday morning after going on a Friday night bender, to
Never
10
happened.
being metaphysical certainty, Forrest Gump, I just ran. What are we going to see on a bank run?
Well, I'll tell you, I don't know about a bank run. I think the banks are already running. I see this as a massive consolidation point. Now, I'm not going to put my tinfoil hat on, but I will say this. I love technology. I love technology. Technology is great. I'm a big I love digital currencies, blah, blah, blah. But there's one danger. If you want to track everyone's capabilities, you want to really maximize taxes for an ecosystem like a federal government, you want banks to be consolidated. So what are we seeing is the regional banks? I mean, what we're looking at in the news, I mean, First Republic and Jamie Dimon's looking to bail out First Republic. It keeps happening. I don't know if this is a massive run, but what I do see is a massive consolidation. And I see also a move away from paper to digital. And that's been happening anyway, but this is the sort of the final straw where now the big, whoever runs the world has the opportunity to kind of digitize this movement of this currency. And I think that is what we're seeing play out in front of us, is what I say.
So I'll put you at a 10 on consolidation, maybe a 4 or 5 on a run.
I don't think I'm much different than there. What did you say the number was last Thursday in terms of withdrawals online?
42 billion.
42 billion.
That's Silicon Valley cash they sent out the door.
Yeah, I think
because the old rules of we're going to guarantee up to 250, you have to have so many physical branches per X number of miles. That's because they literally, when they wrote all these rules, it was about people physically going down to the branch, filling out a withdrawal slip.
That's how 2008 happened in the first place.
Yeah. We were talking about this too. You know, the notion that the Fed's going to capitulate here and go from QT to QE is going to be potentially compounded by the fact that people will stop spending at a personal level because all of a sudden security, the sense of security in their deposits has gone way down. And so, you know, does it create this compounding kind of mitigation of inflation with softening of rates or softening of the posture on QE, QT versus, you know, I'm just not going to spend anymore. And that, you know, that means inflation kind of starts to take care of itself. And we're seeing it manifest in crude, you know, that's other issues. But
I think the most conservative people by nature bury money. You know, they have it in other things like gold and hard assets, if you will. I think those people in general, which is probably the older generations, as you will, not us, clearly. I think they're already getting nervous over the economy, stupid. As I talked, you know, a few weeks ago, like we have wars, we have bank runs, we have pandemics.
The Russians shot one of our drones out of the air.
The Russians,
the other major nuclear power. Yeah.
And guess who's in Russia today?
Xi. Yeah.
That's right. Xi's in Russia. But I think the millennials and down, the Gen Yers, whatever, Gen Zers, I don't think they give a rat's ass what's happening because it's all they know. And they're just like, can I just Venmo you? I mean, they're still on Venmo. Like once Venmo gets shut off, then we're screwed. It's not a bank run. It's when Venmo shuts its doors and one of these, you know, currency collector type companies, that's the bank run that could really cause issues.
Okay. So we got to get out on this issue. Y'all are both way too conservative on this. I am at a 9 out of 10 on major bank runs in America. I still remember pictures from the Weimar Republic of wheelbarrows of money, and that happened fast, and that had no technology.
Wait, dude, I'm at a 8.5.
Well, you're on consolidation. I'm talking run. I'm talking like mass collapse.
Okay.
But
well, here's my question. Where are you gonna put the money?
I know. You're going to wind up buying T-bills, right?
I did have a guy text me saying, hey, and he's like, hey, you know, as he's whispering, I'm like, it's already on text, so Apple knows exactly what you're trying to do here. He's like, do you know where I can buy gold that's not like reported? I'm like, maybe, but let's chat. Yeah. And of course, Siri heard it too. Yeah. So I'm like, yes, people are starting to get nervous. So I'm starting
Yeah.
to, ooh,
There we go.
I'm starting to amp up my number. Maybe I'm at a 9.
There you go. All right. So, Mark, we have the world potentially collapsing on banks. Walk us through what that means for the energy business.
Oh, we finally got there.
Well, it's just a huge overlay of risk off, and I think anything largely industry sector and certainly company specific takes a huge backseat to just the macro level of risk, which you see a big sell-off in equities, and unless the news is hugely positive, and I don't even know if that's the case. You know, we're in a the last few weeks where for example, the DOE numbers have been pretty tough. Now you have something including the adjustment factor being outlier large, just creating fundamental uncertainties and questions about data quality. So if you bake all that in to the energy equation, I don't need to be taking incremental risk here. And so let's wait and see how, what the Fed says on Wednesday. Are we going to get all that aggressive betting on, the strong emergence of Chinese demand or the uptake of Chinese demand? The market's slightly oversupplied right now. What's the case for getting out in front of that? Don't talk to me about, well-specific things. Don't talk to me about, relative degrees of oil versus gas positioning. Just look at the risk profile of energy equities in general. And when we get into this period of where the bets are really being placed on whether or not we go into a recession, whether there's a run on banks, all these related events from a true global macroeconomic standpoint, all the specific fundamentals to energy industry don't really matter.
So, Kirk, you are producing 200,000 barrels a day of oil in the Permian. You're unhedged. So you're free production, and it's longer life production. You've been drilling for a while, and you got all of it. What do you do?
I have no clue at this point. I mean, I keep selling. Do I definitely don't want prices to go down if I'm selling, of course.
Yeah.
I mean, it's at 60, what is it, 67 today, crude?
Yeah. I mean, who'd have thought? I mean,
Man.
We were almost 2x this.
I know.
When Putin marched into Ukraine. Mark, what do you do?
Let me finish the last point. I saw one feedback from the road, if you will, analysts out talking to, I think it was TPH, talking to investors in general. Sentiment was, look, we think this is a good buying opportunity, but there's patience with respect to putting that money to work. And so, as an operator, I hope at this point that I've gotten my leverage house cleaned up. I'm probably taking, if I can get out of some things in my lesser inventory from a drilling commitment, I'm probably laying those rigs down and conserving cash flow.
Because, you could have talked to me I'm CEO a year ago of a company. Putin marches into Ukraine, $120 oil. If my guys and gals walked into my office and said, man,
let's go
inflation,
borrow.
well, yeah, inflation's through the roof. Let's go borrow. I.e., even more practically speaking, can we sign a 3-year rig deal? Because inflation's through the roof. I probably do that. So, looking at these rig rates or rigs running right now, I don't know how many of them you can shut down. I mean, I'd love to see some data on how many long-term contracts are out there, because I probably would have signed them.
Yeah, you have multi-well pads. I think we talked about this a little bit last studio show about whether or not gas rigs would start coming off. We'd seen fairly stubbornly high gas-directed rig count. And part of that is a timing issue and contractual commitment. There's something conjectured this week or last week's rig data points, 555 oil-directed rigs running versus, I think the number when crude was last year roughly 2 years ago, or May of 21, was about 330. 250 of those 55 thereabouts of those 555 are in the hands of private operators. So it's going to be really interesting to see what they do in terms of maneuverability, right?
I mean, aren't we repeating the same mistakes? I mean, what did we learn from the shale boom? I mean, cash flooded. There was no financial discipline. How many people went bankrupt? I mean, this is one of those moments.
But you're not going to lever up to get through this. I think that's the one thing that
I'm like, borrowing today sounds like if it's almost like saying I need a grand slam to win. It could pay off huge, but I say the risk of it paying off is not worth it.
Well, and the other thing too is it's not like, I mean, the thing about the shale revolution is you traded at 10 to 12 times EBITDA or $50,000 an acre or whatever wild ass metric you want to talk about. There was all the incentive to go borrow and buy more and do it. Nowadays, at kind of 3 to 4 times EBITDA, I don't think you're incented to do that. So if the rigs can come down, I think they come down. It's the long-term contract issue that I don't have a good handle on.
If we're more disciplined today and as a result of what we've learned over the last 3 years, then faced with this type of, potentially structural set of challenges outside of strictly the energy sector, then the prudent, consistent from a risk appetite standpoint would be to take rigs down and conserve capital.
I mean, I just, you think that last year was the most volatile year on record for gas prices. And so we think about, like, we're talking about from the supply perspective, there's a lot of gas in the ground, but there's been a lot of transportation issues, and it's actually, you have to look at the actual granular details to figure out what to do. So if I'm in the Permian, probably not as worried, but I'm looking at some of these supply constraints, as well as, the fact that coal-fired power plants have been retired in mass. There's not enough inventory to replace. It really is almost depends on where you are and what the opportunity is. And so I mean, this is an amazing time right now because of the massive volatility.
So here's what we're going to do, and I'll go first this time because usually I put y'all on the spot. You're an operator, define operator however you want to do it. I'm an operator. I'm dropping rigs today. I might be buying some out of the money puts just cause there is a bad wrong scenario in front of us.
Big
possibly
time. Especially if one of your original New Year's broadcast comes true.
Oh yeah. Yes, that's true.
China and Russia are meeting right now. I mean, there's a lot of volatility.
I mean, and
Trump gets arrested, boom, nuclear, everything just
dogs and cats sleeping together.
Mass hysteria.
Exactly. Mass hysteria. Okay, so as an operator, I'm dropping rigs, doing some sort of hedging to the downside. I'll let the smart geeky traders in my organization figure out exactly how to do that.
Yep.
And if I've got debt, I'm paying down debt. And I may even disappoint my shareholders a little bit by, hey guys, we're going to cut the dividend a little bit just to do it. But I'm going into hunker down mode. Mark, what are you doing as CEO?
Well, as CEO, I'm doing the same thing I did for 10 years as a portfolio manager of equities, which is looking for the most efficiently priced downside protection, picking my tolerance point, whether it's 10%. Your long puts, would be very expensive here, just given the level of volatility. So, what's your risk assignment to the various degrees of that downside scenario, and then building a meaningful put position around that. Some of that will be governed by how low I've gotten my leverage profile and how clean my balance sheet is. Is it a fortress balance sheet, as Arjun Murthy calls it, to withstand another? I agree with you. I think the term black swan's a little bit overused.
The annual non-recurring black swan event.
That's right.
Yeah.
And if you're scratching your head about, well, in the category of maybe overthinking a little bit, I do believe all of these, kind of gut punches that we've been through in the last, since 2014 have done nothing but constructive things for the macro, because it's protracted the underinvestment in the global production base. And you're just not going to be able to kind of restart that, assuming there's a real healthy demand spike coming at us later in the year or into 24. So I'm buying the insurance today.
Okay.
Right.
So you and I are kind of here. Kirk, if you're going to do the same thing, I have a different question for you.
What is it?
Is there any reason to go on the offensive here? Go buy everything you can.
I mean, I'm going to
back the truck up.
I'm conservative.
Lever the balance sheet.
I want to
give your stock to anyone that'll take it.
I'm worried about, number one, my employees and them keeping their jobs. And two, my investors. Ultimately, my investors want transparency. And usually I think companies that trade at the highest multiples have the most predictability and transparency. And they're focused on three important things: liquidity, profitability, and growth. In a volatile market, in these volatile times, we really don't have a lot of predictability. So I'm like, the risk is too high to back the truck up, go borrow a bunch of money and try to buy the farm. Now, there were guys that could afford it, the Rockefellers of the world that figured out how to do that. But I don't think, as a small producer, I'm not in a position to go back the truck up. I'm here like, let's just keep operations. Let's keep going. There's too much unknowns. I'm not going to be able to predict what's going to happen tomorrow.
Right.
And unless I'm in that environment, I can take a little bit bigger steps. So I'm saying conservative.
Let me add one thing to this. I do think, and I've made this point before, I do think we're in a longer term period of where the industry has been taught the lesson that motivates much more deliberate behavior. So if you're the only one out there being really aggressive, back up the truck right now, you're kind of competing with yourself. And it may be naive to say that you're going to have a little more time, because there's going to be some hesitation when we get a bit more of an all clear signal. There's not going to be this mad frenzy of trying to snap up every, set of properties, for example, using the E&P side, that we can. I think there's a more deliberate pace even coming out of this. And we're going to need to see more in terms of that all clear, because, we've been through some unprecedented things here from a liquidity standpoint, from an inflationary standpoint, from a cost of capital standpoint. Everybody, trading at 3 or below times EBITDA. You're just not going to be aggressive with your equity capital, given what your equity holders have been telling you and demanding for an extended period of time.
So let's do this, kind of our get out question. And Kirk, I'll go to you first. You are now the chief investment officer, and we'll just say Rice University, my alma mater. So you got, call it a $7-8 billion.
Smart people over there.
Oh, I know. This is really cool. We got to give a shout out to Allison Thacker, because she's great. My dad and mom have given a scholarship at Rice. So you get a package from the Rice Management Company, i.e. the endowment, and it shows what the returns over time have been. And Dad's like sitting there going, I wish they'd manage my money. So anyway, I sent that to Allison. So you're Allison Thacker, and you can have a little bit different objective than Rice wants. Take it wherever you want to go. But you've got an endowment of $5 to $10 billion. Tell me your portfolio construction today, and then tell me where energy, if any, is going to fit into that. And let's be on the record here making calls so we can look back at this in 2 or 3 years.
Well, I'm going to only focus on the energy side.
Okay.
I'm long gas.
Okay.
I think long U.S. gas.
Okay.
I think we could be the cheapest producers. I believe in exporting. I think LNG for U.S. export is big. So I'm going to have a portfolio of long gas assets in the U.S.
Okay.
Whether I put that into, individual companies or not I'll let the smarter people figure out exactly what to buy specifically, but that's an asset I think is going to be pay dividends long term.
All right. Mark, you can be the energy investor and say where you're going to do it, or you can go up top and be CIO and talk your whole portfolio if you want.
I'm going to stick with energy here as well.
So you're not going to buy General Mills. We're not going to talk food and
being consistent with, and I may step outside of the classic definition of energy, and being consistent with my first draft pick in the energy draft of natural gas. I agree with that as a structural long-term thing heading into the end of the decade. I think we may have a couple of soft years to go here, but there's no way around what's coming in terms of the global supply chain, right? And the demand that's going to come out of that, or that's going to drive that. I would be with the fortress balance sheet U.S. integrateds. I might have a position in, the highest quality Permian, which is nice and boring right now. If you look at the names that are still available that have some capital liquidity. So, I like the best basins in the world. I like U.S. gas. And the kind of add-on or the extension, because I think we will continue to push hard on the renewables additions that are going to be made, particularly batteries and the like. I really like where minerals sit right now. I just don't know how to express that. There are a lot of people that cover that for a living, but I go back to the notion that I think if you took Apple's market cap today and used that to buy mining companies, you could buy all 100 of the top 100 publicly traded mining companies and have enough left over to buy, I think, 2 years worth of global copper production. I think the root or the kind of foundation element, the cornerstone of batteries and renewables is, got some multiple expansion ahead of it long term, just because of the scarcity of supply that's going to be needed to address if we're going to get to these multiples of growth in batteries and EVs, for example.
You could read my blog on this, on the scarcity of those materials.
I have.
We're running up against a brick wall. So I think that's a pretty wise move. What say you?
So I'm going to play CIO here.
Okay.
And I'll make this up. If generally you're a third public equities, you're a third public debt, and you're a third private capital as an endowment, just to kind of make up a number. Massive shift for me into inflation hedges. Oh. So where of that private capital at one point, I think in the middle of the heyday, maybe 10% of that was kind of energy, maybe 12% was energy, and that was your traditional inflation hedge. I've got 40 to 45% of the portfolio in inflation hedges, and I'm going old school gold, I'm going Bitcoin, I'm going energy and commodities, because I'm scared we have hit Weimar Republic time. The rest would be more kind of heavily weighted. I'll stick here in the United States because I think we're going to be the healthiest member of the leper colony. Would be in U.S. equities of kind of all of our best companies, and I will have the lowest amount of bonds on record that I've ever had.
Amen to that.
Yeah. And Allison's going, do the opposite now.
Great call on gold, by the way.
So, yeah. All right, guys. Does anybody have a finger of the week?
Well, I can tell you some good news and bad news.
There you go. Lay it on us.
Global warming, according to the UN, global warming set to reach 1.5 C sooner than we thought.
Okay.
And level set it here. What does that 1.5 C mean in terms of a reference point or a baseline?
No idea, man.
You always choose 1850, right? Because that was the lowest point we've seen in the last 10,000 years.
Let me get.
Although I have a dear friend coming on the podcast tomorrow, and it'll probably drop
1850.
in 2 weeks. Yeah.
So it is.
That's because it was the lowest.
It's a bit of a quiz you passed.
Yeah, exactly.
So
where's the lowest point? There we go.
Yeah. So
according to the almanac,
the fundamental fact of these predictions or these trend analyses is that they're looking at multi-decade endpoints or prediction points that are purely model driven, right?
Absolutely.
And so we could do a whole episode on modeling. Old reservoir engineer here, and modeling dynamic complex natural systems is
corporate finance analyst right here.
Yeah, we model, we build models. What do you want it to say?
I never had an number right.
I may not have a finger of the week, but I have a thumb of the week.
All right.
Give us a thumb, man.
If you're not paying attention to baseball, there's something going on right now called the World Baseball Classic. It's like baseball's Olympics that comes along every 4 years. Players.
Altuve got hurt, didn't
he? He did. That's where this comes in. I'm not going to give it to the pitcher. I'm going to give it to the baseball itself that found its way to break Jose Altuve's right thumb and have him sidelined for at least the first 8 to 10 weeks of the season. And I heard somebody say it this morning, look, this is especially important for Altuve, who's entering his 13th season. We'd like to see him get to 3,000 hits, for example, and you knock out chunks of seasons, particularly in later in careers.
Particularly because he's still borderline prime, so you hate to lose 10 weeks in borderline
you
prime.
You said it, and you're not supposed to say it.
Yeah, he was top 5 MVP last year. Yeah. Right. So I'll give it to the actual ball that broke his thumb.
All righty.
So it's the thumb of the week.
We'll do that. That being said, it's good to see Mike Trout actually play meaningful games.
That's a good point.
All right, everybody. Appreciate you tuning in. If you enjoyed it, please subscribe, share it with a friend, and we're out.